Welcome to the deep dive. When we think about the actual architecture of the global economy, the images that pop into our heads are usually, like, highly physical.
Right, yeah. Like massive bank vaults.
Exactly. Gold reserves or, the high-frequency trading servers with the blinking lights, billions of dollars moving across digital screens. We just sort of operate on this assumption that the ultimate power in finance lies in the capital itself.
I mean, it's intuitive, right?
Yeah.
Money makes the world go round.
But what if the most powerful tool in the entire financial system isn't actually capital? What if the most powerful instrument is just words?
It's a profound shift in how we even view economics.
Yeah.
Because we are so conditioned to look at central banks as these, mechanical entities, like they just pull levers on interest rates or print money.
Yeah.
But in the modern financial architecture, the words chosen by a central bank, they don't just describe the economy. They actively construct the economic reality that, we all operate in.
Yeah. And we actually have our hands on an incredibly timely academic paper today that unpacks exactly how that construction works. It's a piece from the Global Review by Dr. Fareed Novin.
A fantastic paper. Really dense but fascinating.
Yeah, and it basically drops us right into the middle of this high-stakes, real-world natural experiment happening right now. Like, literally right now in April of 2026, we're watching this massive clash of communication philosophies between the outgoing Federal Reserve Chair, Jerome Powell, and his incoming replacement, Kevin Warsh.
The contrast there, I mean, it really could not be starker. On April 30th, Jerome Powell is scheduled to give his 63rd and likely final post-meeting press conference.
Wow, 63.
Yeah, and over his tenure, Powell engineered this architecture of extreme, just relentless transparency. He basically made the Fed an open book.
Right.
Yet just days ago, right, on April 21st, Kevin Warsh sat in his Senate confirmation hearing and essentially proposed a controlled demolition of that exact same architecture.
He wants to tear down the whole communication machine.
Yeah.
And for you, the listener, this is not just some inside baseball debate about PR strategy.
No, not at all.
If Warsh gets his way and the Fed goes silent, your mortgage rate, your business loan, your retirement portfolio, they aren't just determined by the underlying economy anymore. They become heavily influenced by Wall Street trading in the dark, basically just guessing what the Fed is thinking.
Yeah, exactly.
So our mission today is exploring this fundamental question. Does constant, transparent communication from the Fed actually help the market price things efficiently? Or does it just create like a chaotic echo chamber of noise and volatility?
Well, to really get to the bottom of that, we have to look closely at the Warsh doctrine versus the Powell legacy, because Powell aggressively expanded the Fed's communicative footprint.
Oh, massively.
Right, we went from 4 press conferences a year to 8. He leaned heavily on explicit forward guidance. And of course, he utilized the dot plot to telegraph the exact path the committee saw for future rates.
So the market was never really left to guess what the Fed was thinking on any given Tuesday.
Precisely. Which brings us to the Warsh alternative. Because Warsh is advocating for what he calls a backseat Fed.
Right.
He argues that central bankers speak way too frequently. His whole philosophy is that the Fed's primary focus should be on internal truth-seeking rather than, public repetition.
Okay, let's unpack this because I was thinking about this in terms of taking a road trip.
Okay, I like that.
It's like being a passenger in a car where the Fed is at the wheel, right? So Powell is the driver who narrates every single upcoming turn, every lane change, and he warns you about a pothole like 3 miles in advance.
You're never surprised.
Exactly. You never feel surprised. But Warsh wants to be the driver who sits in total stoic silence and only yells, "Brace yourself," if you're actively careening toward a guardrail.
That's a great way to put it.
But the core economic question is, which driving style actually gets you and the global economy to the destination safer?
And Dr. Novin's paper answers that by looking under the hood of how market participants actually process those words. He uses what's called a Bayesian game-theoretic framework.
Which sounds incredibly dense.
It does, I know. But it is actually this really beautiful mechanism to describe how humans update their beliefs.
Okay.
So in a Bayesian model, a trader starts with a prior belief about what the economy will do.
Okay.
When new evidence arrives, like, say, a Fed statement, they mathematically update that prior belief to create a new, more accurate posterior belief.
Got it. And the game theoretic part comes in because that trader isn't just reacting to the Fed in a vacuum, right?
Yeah.
They are anticipating how every other trader in the world is going to react to the Fed.
Exactly.
It's like a massive multiplayer game of anticipating everyone else's Bayesian updating.
Yes. And when you put those two concepts together, the paper maps out this virtuous cycle of information. It's a 4-step positive feedback loop. So step 1 is the central bank providing a precise, credible signal, like clear guidance on their policy path.
And because that signal is clear, we immediately hit step 2. The mathematical dispersion of beliefs basically collapses.
Right.
Because, if the Fed is silent, traders are just guessing randomly. Some think rates go up, some think they go down, and that high variance creates wild swings in the market.
Absolutely.
But when the Fed signals clearly, those millions of mental probability models suddenly snap into alignment, the disagreement just vanishes.
Which triggers step 3. Once the disagreement vanishes, the market prices themselves, whether that's, the yield on a 10-year treasury or the pricing of inflation swaps, they become highly informative.
They get clean.
Right, they get scrubbed of the volatile panic premiums and all that speculative noise. The yield curve stops reflecting Wall Street's anxiety and starts reflecting actual economic fundamentals.
And that leads to the final step, step 4. The Federal Reserve looks at those clean, noise-free market prices to learn about the actual state of the economy. They use that clean data to calibrate their next policy move.
Yeah, and we really need to pause on step 4, because this is where the dynamic gets truly fascinating. The central bank is actively learning from the market.
Wait, this is the part of the cycle that made me stop reading and reread the page?
Oh, for sure.
Because the Federal Reserve employs literal armies of PhD economists. They have supercomputers, endless data sets, access to proprietary banking info. Aren't they supposed to be the ones with all the answers? Why on earth do they need to look at the bond market to figure out what's going on in the economy?
Well, because no central institution, I don't care how many PhDs it employs, can replicate the decentralized computing power of millions of global investors putting trillions of dollars on the line.
Oh, yeah.
The market is an aggregation machine. It pulls in private information, local supply chain bottlenecks, real-time consumer shifts, geopolitical risks, and it does it far faster than the Fed's internal models ever could.
So the Fed relies on that aggregated intelligence.
They have to. They need the market to tell them if their models are actually mapping to reality.
So it's basically like echolocation.
Oh, I like that.
The Fed is flying through the dark cave of the economy, right? They shout a clear signal into the darkness. And the way the market bounces that signal back through bond yields and equity prices tells the Fed exactly where the walls are.
That analogy captures the mechanics perfectly. And honestly, this is the core of the paper's argument against the Warsh doctrine. Because if you adopt a silent backseat Fed, you stop shouting into the cave.
Right.
You don't just leave the market in the dark to guess where the walls are. You actually blind the Fed itself because they no longer get those clear echoes back.
The yield curve becomes polluted with guesswork again.
Exactly. And the Fed's policy models just break down. Both sides lose vital information.
And Dr. Novin backs this up with some pretty brutal historical case studies. We can see exactly what happens when the echolocation goes wrong. Look at the 2013 taper tantrum.
Oh, textbook failure.
Right. Ben Bernanke was chair, and during a congressional testimony, he kind of hinted at slowing down the Fed's asset purchases. But he didn't give clear conditions or timing or parameters.
Right, he introduced noise rather than a credible signal. And the Bayesian updating went haywire. Traders had no anchors, so the variance of beliefs just exploded.
And the result was devastating. 10-year Treasury yields spiked 100 basis points in a matter of weeks. Capital violently fled from emerging markets, causing massive global collateral damage.
Yep.
The market lost its anchor purely because the signal was poorly constructed.
Now, contrast that failure with Powell's communication during the onset of the pandemic in March 2020. Financial markets were facing an unprecedented freeze.
Totally frozen.
But Powell deployed massive, explicit forward guidance. He outlined the exact parameters of the Fed's interventions and the conditions under which they would be maintained. He firmly anchored the Bayesian game.
Because the signal was unmistakable, the belief dispersion collapsed almost instantly, and financial conditions stabilized long before the actual economic data improved.
Exactly. Words did the heavy lifting.
But here's where it gets really interesting. The paper has an even more extreme example of this math at work. It's Mario Draghi at the European Central Bank in 2012.
Oh, the classic.
The Eurozone was fracturing. Borrowing costs for Italy and Spain were spiraling to levels that threatened sovereign defaults. And Draghi just steps up to a microphone and states that the ECB will do whatever it takes to preserve the euro.
Right, and this is where the game-theoretic matrix becomes physical reality. because Draghi didn't actually execute any immediate bond buying operations at that moment.
Wait, none at all.
Not a single bond. He just altered the probability distribution for every trader in the world.
He rewrote the math in their heads. Shorting Italian debt suddenly shifted from a profitable, speculative gamble to a guaranteed loss in the game-theoretic model, because the perceived probability of an infinite ECB backstop went to 99%.
Exactly. And Italian and Spanish bond spreads compressed dramatically within days, purely based on the credibility of his words.
It is the ultimate proof that in central banking, credible words are not a precursor to policy. They are the policy.
Well said.
But Dr. Noven's paper doesn't just act as a cheerleader for maximum transparency. It engages very seriously with Kevin Warsh's critique. Because, if this echolocation is so powerful, we have to understand why someone as experienced as Warsh views it as a structural threat to the market.
Right. And Warsh specifically targets things like the dot plot. For over a decade now, the Fed has been publishing these specific anonymous predictions of exactly where they think interest rates will be at the end of the year or, 2 years out.
So what does this all mean for you? If you're listening to this and wondering why the dot plot matters, well, Warsh argues it acts as a psychological trap, a rigid commitment device.
Exactly. Because the committee members are human. Once they publish a forecast showing, say, 3 rate cuts for the year, psychological anchoring kicks in.
They don't want to look erratic.
Right, and they don't want to admit their models were wrong. So they hold on to those predetermined paths much longer than they should, even when incoming inflation or employment data violently contradicts their forecast.
So they become trapped by their own transparency. And Warsh has another critique that really builds on our echolocation analogy. If the Fed is constantly spoon-feeding the market with its own highly detailed expectations, it kind of destroys the market's incentive to do its own homework.
Yeah, the term economists use is crowding out genuine price discovery.
Right.
Think about it from the perspective of a massive hedge fund. Why spend millions of dollars deploying satellite imagery to track retail parking lots or building proprietary models of global shipping lanes if you can just trade based on the breadcrumbs the Fed drops in an 8 times a year press conference?
The market stops researching the actual economy and just starts analyzing the Fed, which ruins the echolocation.
Exactly.
If the market is just reflecting the Fed's own dot plot back at it, the Fed isn't learning anything new from the market prices. It's just an echo chamber.
The aggregated intelligence vanishes. And, this is Warsh's strongest argument. Extreme transparency might stabilize things in the short term, but it hollows out the informational efficiency of the market in the long term.
So we have a dilemma here. If the dot plot traps the Fed into rigid commitments and spoon-feeding the market kills price discovery, Warsh's solution is to basically tear it down and go silent.
Right.
But as we established, going silent blinds both the market and the Fed. So I have to ask, if the paper argues against Warsh, how does it solve this rigidity problem? Is there a middle ground? Like, why don't they just publish a range of possibilities or tie the forecast to specific data triggers?
Well, you've just reverse engineered the exact solution Dr. Noven proposes.
Nice.
Yeah, he relies heavily on Ben Bernanke's 2025 structural review. The paper argues that Warsh is diagnosing the right disease, but prescribing the wrong cure. You don't abolish the communication architecture, you fix the design of the signal.
Okay, so how does Bernanke's framework change the signal?
By replacing the rigid single points of the dot plot with explicit scenario analyses and uncertainty bands. So instead of the Fed declaring, the project rates will be at 4% in December, they provide a conditional matrix. They say, our baseline is 4%, but if core inflation runs 50 basis points hotter than expected, the mathematical path shifts to 4.5%.
Ah, so you show your work.
You show the underlying reaction function. And by doing this, the Fed gives the market high-quality information without boxing themselves into a calendar-based commitment.
Right, so the market knows exactly how the Fed will react to new data.
Exactly, which means the market goes back to obsessively researching that incoming data rather than just guessing what Jerome Powell is thinking. You preserve the benefits of the Bayesian updating without the psychological trap of inflexibility.
That is a brilliant structural fix, but the paper makes it painfully clear that none of these fixes actually matter. Not the dot plot, not scenario analyses, not the frequency of press conferences, without one absolute, non-negotiable precondition.
Right.
The entire mathematical theory of central bank communication rests on the bedrock of credibility.
And in the Bayesian game-theoretic model, credibility is not just some abstract political norm. It is a mathematical prerequisite. If traders and investors do not believe the signal is genuine, they apply a massive discount factor to it. Rational agents will simply ignore information they deem manipulated.
And the paper grounds this math in the very real friction happening right now. It's fascinating how Dr. Novin treats the current events in Washington not as political theater, but as literal variables altering the economic model.
Yeah, he inputs them directly.
Right. Impartially presenting the facts, the paper cites the Trump administration's open, sustained public pressure on the Fed to lower interest rates. It inputs the ongoing Department of Justice inquiry into the Fed's building expenditures. And it incorporates the implications of the Supreme Court's Cook case, which challenges the fundamental protections of independent federal agencies.
By treating these events as inputs, the model reveals a pretty stark reality. If market participants input those variables and calculate that the Federal Reserve's signals are being dictated by political pressure rather than hard economic data, the Bayesian updating process just collapses.
Because if the market thinks the Fed is just saying what an administration demands they say, to juice the economy before an election, the words lose their power to anchor beliefs.
Completely.
It doesn't matter if you have 8 press conferences a year or if you use uncertainty bands or publish 50-page scenario analyses. If the market fundamentally does not trust your motive, the echolocation is dead.
The market stops listening to the central bank and starts trying to model the unpredictable whims of politicians instead. And the paper defines this as a plunge back into the low transparency equilibrium.
We fall right back into the dark cave. Volatility spikes, the belief dispersion widens, and the transmission of monetary policy slows to a crawl. The yield curve just gets flooded with risk premiums again.
And this is the context that makes Powell's forceful defense of central bank independence in his March press conference so critical. It isn't just a matter of institutional pride or preserving a legacy.
Right.
It is a desperate attempt to protect the fundamental math that keeps the global financial system functioning. Without that perceived independence, the value of the Federal Reserve's signal literally drops to zero.
So as we wrap up this deep dive into Dr. Novin's research, the profound takeaway here is that communication isn't just PR for the Fed. It is the actual infrastructure of the modern economy. The words central bankers choose and the credibility behind those words create the financial reality you and I live in.
Absolutely.
Dr. Novin captures this perfectly in the paper's concluding line. He writes, "The central bank's most powerful instrument is not the rate it sets, it is the belief it sustains."
I mean, it's a phenomenal summary of the last decade of monetary policy. But there's one final thought I want to leave you with, pulled from a really brief, fascinating detail buried deep in the footnotes of this paper.
Oh, I love the footnote.
Yeah. Dr. Novin cites a 2025 study conducted by the International Monetary Fund. The IMF researchers took a massive large language model and fed it nearly 75,000 central bank documents, speeches, and minutes stretching back decades.
Oh, wow. So they mapped the entire historical dialogue.
They did. And the AI proved mathematically that incredibly subtle linguistic shifts, like a slight change in sentiment, the deployment of a specific adjective, even a hesitation in a transcript, directly and predictably dictate future market rates.
Wait, really?
Yeah. The AI was able to map the exact code that programs the economy.
So words literally are the code.
They are the code, which raises a seriously provocative question for the future of this whole Bayesian game. If the central bank's words are the literal programming language of the global economy, and we now have artificial intelligence models that can instantly parse every single syllable, sentiment shift, and nuance far faster and more accurately than any human bond trader.
Oh, man.
How long until algorithms, rather than humans, are the ones truly carrying on this continuous dialogue with the central bank?
That is a staggering thought to end on. We started this whole exploration asking if the most powerful tool in the global economy is just words. It turns out words are the ultimate currency, but the entities reading and reacting to that currency might not be human for much longer. Thank you so much for joining us on this deep dive. Keep questioning the information around you, and we'll catch you next time.